Good day to all. Welcome to our second part involving our discussions with debt and debt crisis, especially with sovereign or let's just say foreign debts. And here is a pending question that we can basically ask ourselves, and that is, do countries default in good times? That's one question that we can ask. Remember, in the first part, we mentioned that the countries would be borrowing money in good times. And then because of that, we can experience as, for example, creditors that our borrowers from other economies cannot pay during the bad times later on. So basically, the borrowing, of course, is the precursor of the defaults later. And then there were some unique circumstances that because our rights are not protected in that particular situation as again sovereign debt as creditors, and that's why certain countries, even if they have the capacities, they would not pay. So to answer that, still they can default because we don't have a bond or a hold with them, and it depends upon the contract or the negotiations anyway. Also, laws would provide certain backgrounds about this, like there are no laws that protects sovereign debt for the creditors. So what do the data say? We can see here that default happen in waves. So basically, we have certain brackets of years, and then there were events that happened in between. Then basically they happened in those brackets. We can see like in 1824 to 1840, 19 events, 14 in Latin America, recent independence and civil wars, then long restructuring periods after the war. And then after that, 1840 to 1860, when the situations have been settled. So we see six events, and then there's credit boom. People now became settled, and then they wanted also to move past the said war, so they borrowed money. It's like a cycle that can happen. After that, 1861 to 1920, 58 events, much faster restructuring, and so on and so forth. But in 1921 to 1940, we have 39 events, Great Depression. Sad to say, the economy there, especially in the US, experienced even below the recession. So there's really like very negatively dramatic economic activity, plus the World War II. Then 1941 to 1970, supposedly credit will boom, but there's only little lending after that. In 1971 to 1981, 15 events, boom in syndicated bank loans. So the loans are provided by big organizations called syndicates. Then in 1982 to 1990, 70 events, the debt crisis happened. 1991 to 2004, 40 events that happened, lending booms again and suddenly stops. So we can see this in the graph that they are often linked to bad external financial conditions. So what do you mean by they? The they here are basically the debts that we do have. So we can see on the x-axis our months and years, and then on the y-axis the EMBI composite spreads on basis points. So basically, the particular experience on our debt would be changing from one point in time to another. We can see the peaks with the crisis. So tequila crisis, and then crisis, of course, would result the defaults during, of course, these times or these times. Then Asian crisis, though at the lower part, but it was, of course, coming from a bottom here. So when it peaked, it's just here. Again, compare that with tequila crisis with here already. And also with the Russian upper part, September 11 attacks somewhere here in the middle of Russian and Asian crisis, but we can see that it actually increased when there was crisis. Then that was 2001 though. in 2003, Brazilian elections and corporate governance scandals in the US, the Enron scandal, which is famous in 2001 going to 2002 and 3. So we can see also here the peak and the subprime crisis in 2008, wherein certain real estate that were already mortgages of loans were being also used as collaterals for other loans. It's like double collateral for a certain real property, which is challenging to in cash or convert to cash should the events that defaults coming from certain borrowers can happen. And that would be the challenge. So we can see this in this graph. Hopefully you can pause this part here and look at this particular graph and see the trend and pattern. EMBI actually stands for Emerging Markets, Bond Index Composite Spreads. Actually, these particular indices, let me just focus with EMBI, would involve certain bonds coming from emerging or new markets. Normally, they will provide higher yields or higher rates of returns if we compare them with established markets or even with the government bonds. That is because if, of course, we have emerging and new markets, so basically there are higher risks. And when there are higher risks, we expect also that there would be higher returns. Remember the direct relationship of risks and returns. Right, then, do defaulter pay a high cost? Like the borrower would default, would it really pay high cost? Now we can see here years after the default episode and the sovereign spread, just change the spelling accordingly, the basis points. Now we can see that the spread would go lower. So in the earlier years, it would be with a higher cost, but it would go lower by then. 3 years after the resolution of a default episode, there is no statistically significant difference between the spreads paid by defaulters and non-defaulters. So that's the thing though. And we find similar results if we look at access. Global factors like risk aversion, which means we avoid risk. So whoever would be the risk aversers are those who will be avoiding high risks. So risk aversion is a concept of avoiding high or higher risks. And US interest rate appear to be more important than the default history. So these factors are more considered for defaults than history, as said there. Then there is some evidence that defaults have a negative effect on trade, as said in buying and selling, considering also with the reputation of the borrower. But this is still controversial. That's something to be taken note of. And the channel is not clear. No evidence that defaults have a direct impact on trade credit, and no evidence, at least in recent years, of explicit sanctions. So that's the thing. Although we said that there are costs involved, but there are no explicit penalties or surcharges to be paid. Then what will the data say still? Anyway, who cares? We do know that defaults are bad because they lead to deep recession. So recessions when activities in the economy are going to be lower. So in that case, in fact, we can see here that econometric estimates found that on average, default episodes are associated with a 2 percentage points drop in GDP growth. So basically, the GDP would drop. Also, the default episodes, meaning certain borrowers out of the sovereign debts would be defaulting or not paying because there has been a downward movement or GDP. So there's really going to be somehow a sense of negative impact on the GDP, not necessarily going to lead though to bad economy, but we can just see the connection that when there is a drop, so economies would be tending to default also. Then after that, we have the question, but do we really know what we think we know? So that's a challenging question and very interesting. We think we know it, but do we really know it? Do we understand what we are knowing? Are default episodes bad for growth, or is it low growth that causes default? And another is that is, do defaults happen in bad times really? That is one question. Causality is always very hard to assess. But if you look at high frequency data, we find that growth collapses anticipate defaults. So if the economy is going downwards, we expect also defaults, which is somehow realistic really. That's the usual thing that can happen. Our ability to pay decreases with our income also decreasing. Default episodes are often followed by a rapid rebound of the economy. So that's also one thing that we should take note. Then we can see that here with 0 in the middle, the event time, negative from the left and positive on the right. And we can see that there is an upward sloping movement from left to right. So default episodes are often followed by a rapid rebound. If there's a default now, there would be a rebound later on. Everything in the market is temporary though. Then here's another interesting topic. Do countries default too early or too late? And this is a certain comment coming from a source, Blue Sign 2005, page 163. I will not mention the H word, guys. It's up to you to read. The last thing I should be doing is tell a country we should give up our claims. But there comes a time when you have to face reality. This is an unnamed financial industry official. Both are taken from the same source I mentioned a while ago. And also the bottom remark. So, of course, if there are still claims, then we should not be giving up. But of course, there could be some realities wherein we cannot actually collect. But hopefully it won't happen. Another one is the problem historically has not been that countries have been too eager to renege on their financial obligations, like to abandon their obligations, but often too reluctant. Like, sad to say, they wouldn't want to pay, for example, but it's not like they're not going to pay. So somehow like thinking hard about it because the amounts are in bigger values. And this is coming from memo prepared by the central banks of England and Canada. Then what about the cost of default? Politically speaking, there is a small literature of political costs of currency devaluations, like the currency would be going down because of the defaults. In 2005 by Frankel, it has been found out that a devaluation increases turnover of finance ministers from 36 to 58%. And then applying this approach by Frankel, bond defaults increase minister turnover from 19 to 40%, but bank defaults increase it only to 24%. So in this case, if there is a devaluation or losing of value of the, let's say, currency, then this increases the turnover of the minister. So very interesting concept anyway, politically speaking. Like the money would go down, so people would be losing their confidence with those charged with governance. Governments lose votes after the defaults. So again, if we found out that our government is defaulting in the payment, so public would be losing confidence again, and that would affect the vote. The high political cost of default may affect the timing of the decision by the government. It could cause gambles for redemption. So it can cause them to think of ways to really solve the problem. Now, let's check about the Mickey Mouse model, what that is. So the Mickey Mouse model actually states that our economy will be affecting also what is going to happen to the society and environment as a whole. So it's like a concept in sustainability accounting and reporting wherein there is the three pillars or the three P's. We have the planet, which stands for the environment or earth. We have people, that stands for the society, and profit for the economic aspects or the economy. So those things are very related to each other, and that's under Mickey Mouse model. So with defaults, that would affect also the environment and society. Then another one is summing up theory versus reality. Theory, countries get into trouble because of lax fiscal policy. We said that countries borrow in bad times. There are financial difficulties, so that's why countries would borrow. And if ever countries default in good times, that would be strategic or their ways of like managing their resources. So if anything, or if something happens like this, they default too much. And defaults are very bad for the economy with long-lasting negative consequences. The reality, though, is that many debt explosions have nothing to do with fiscal policy. So in other words, we have huge amount of debts. It's not really related with or not strongly connected with a fiscal policy, our government spending and taxation policies. Then we also have to take note that countries really borrow even in good times because they want the economy to grow, and countries default in bad times and justify defaults though, and sometimes too late. Defaults do not seem to have long-lasting negative consequences because there can be recoveries later on. That's the reality. An outline, so this has been said already a while ago, so hopefully you're able to look into that. Facts is how debt grows, when do countries borrow and default, policies, avoid debt explosions, increasing debt, what to do during the crisis, and how to deal with the defaults. Then fiscal policy can be prudent. So we control the flow of debt, only borrow when the social return is higher than the opportunity cost of funds. We can say that there are really benefits that we can obtain from borrowing the money, and the cost, or let's say the benefits foregone, would be lower. This requires strengthening fiscal policies and institutions, like the rules could be improved. Then the budget institutions also have to be properly carried out and organized and implemented or maintained or supported. So we have the hierarchical rules and the transparency rules. Like motherhood and apple pie, this is always good, but it may not be enough. There are also other things that we have to consider. Another one is avoid disasters in the banking sector. It is mostly about preventing lending booms, like there's too much money being borrowed. And well, but low debt can't buy you love. So if you want love, you have to invest. That's the basic concept in the modern world. Like there are always costs involved, even with love. And the higher that love is, then the higher the debt to be obtained. We can see it here that low debt is not enough. So on the bottom part, we can see our GDP being involved. Let me check that. Let me minimize this for a while. Let me minimize. So we can see anyway these circles and groups. On the y-axis, we have the Standard and Poor sovereign rating, the S&P, which would focus on the ratings of the investment. So that's what you can see here, from lowest 0, B minus, BB minus, triple B minus, then A minus, AA minus, and AAA. So let me again minimize this one. Hopefully this can be effective. All right, so again, it's not moving downwards. We're back. So the x-axis is actually the percentage of debt over GDP. So we can see here like 10%, 20% in intervals of 10. Then we can see that, for example, for the Philippines, it's here in between 50 to 60% for percentage of debt over GDP. And the rating is somewhere close to BB minus. So that is from 1995 to 2005 rating. And we can see the groupings here in blue and red. So the red ones are, of course, very close to each other, as well as the blue ones. Then low debt is not enough. We can see that if we would like to grow, then we should also increase our debt to be able to use that for the spending. Anyway, the good thing is that in financial management, debt is a leveraging way, because actually it would provide us fixed obligations. Then low debt is also not enough, like a 10-year government bond rates for Spain and UK comparison. A while ago, that's UK and Spain. Gross government debt as percentage of GDP. So we have x-axis the years, and we have here the percentages. So we can see that for Spain, initially it's like higher and UK is lower. And then later on, UK became greater than Spain. Then here also is a comparison of the 10-year bond rate, Spain and UK. Initially, Spain is higher, and then somewhere in the middle, they're close to each other, but at the end, Spain won. And we are going to, of course, continue with this by next meeting. But before that, allow me to mention about these are the tale of two countries, Spain and UK. And with that, thank you very much for listening. God bless us all, and please watch out for our third part for our discussions. Thank you once again.